So you decided to become a dividend investor and invest in dividend paying stocks. That's great. So if you're Canadian, it's most likely that you will start by investing in Canadian dividend stocks, right? It's only logical. So where do you look? Well, probably where we look for everything nowadays, either Google or YouTube. So what do you get when you search for the best dividend stocks in Canada? Well, you will be bombarded with all kinds of different sites and articles, links, videos, and different gurus. But when you really start deciphering all this stuff, you realize that many of the same stocks keep coming up. Stocks like TD or CIBC or another Canadian bank, as well as Enbridge or Sun Life, Manulife, Bell, TELUS, or Amera or Fortis, etc., etc. So choosing which ones to invest in can be a long and tedious process. But what if I told you there is a much easier and much more lucrative way? You can own the best Canadian dividend stocks by investing in only one ETF. On top of that, you will get a much higher dividend yield than if you would own all these companies individually. So the ZWC ETF from BMO makes this all possible. So in this video, I will explore this ETF in detail and show you why it's the best or one of the best ETFs that all Canadians should invest in if they want to invest in dividend paying stocks in Canada. ZWC is a Canadian listed ETF managed by BMO, one of my favorite ETF managers in Canada, and its primary purpose is to provide investors with a safe, a consistent, and a very high source of income every single month. So the name of the ETF is the Canadian High Dividend Covered Call ETF, and as many of you know already, I absolutely love covered call ETFs. If you have no clue what the covered call strategy is, I will try to summarize it quickly in this video in just a few minutes, but I want to focus more on the ETF itself. So if ever you're confused or don't understand it after my explanation, make sure to check out my covered call strategy video. The banner should be appearing on your screen right now. So I discussed that in detail in that video there. So the covered call strategy is basically a zero risk way to enhance the dividend yield of an ETF by using options trading. So options trading is a tricky affair, more so than trading stocks, and is not something I would ever do on my own. But with this ETF, it's all done by the fund manager BMO, who I trust 100%. So how does it work? So BMO sells call options on the dividend stocks within the ETF. So selling a call option on a stock means that you're selling somebody the option, but not the obligation, to take some shares off your hands at a specified price. In return for getting that option or privilege, they pay us a premium. So these premium payments that the ETF gets or that we get are really what boosts the dividend yield of a covered call ETF. So since the ETF already owns the shares in question, they are called covered calls. If they didn't own the shares in question, they would be called naked calls. And no, that's not a joke, it's just the official terminology. So just to be clear here, the fund manager, BMO in this case, is taking care of selling those calls. So it's completely seamless and transparent to us, the investor. So let's use a simple example. Let's say you own 100 shares of TD Bank and the stock price is currently $70 a share. You could sell a call on those shares to another investor at a specific agreed upon price. So let's say that price is $72 a share. Now with all options trading, there is a time limit for the actual contract. It's usually 30 days. So let's say at the end of 30 days, the stock price of TD is less than $72. Well, in that case, the option expires worthless since the stock price is less than the agreed upon price in the contract that we did of $72. So as the seller, we make a premium, which is basically easy and free money, and we get to keep our 100 shares of TD like nothing ever happened. However, if TD stock goes up to $75 within the 30 days, for example, the option buyer will definitely exercise his option because he will get 100 TD shares for $72 instead of the current market price of $75. So he makes a profit. So this is why investors buy call options. They are making a bet that the stock price will go up significantly within 30 days. So you might be asking yourself, why don't they just buy TD shares directly? Well, buying call options instead can be very useful if the share price of a company is really high, like a lot of these blue chip stocks. Many people can't even afford to buy one share of those companies, so buying call options on them is a cheaper alternative if they think the stock price will go up up in the near future. So getting back to our example, if the stock price goes to $75 within 30 days. On our side, we have to give up 100 TD shares for $72 a share, even if they currently worth $75 a share, to fulfill and close the contract. So don't forget that we had the shares at $70. So we still make a small profit getting rid of them at 72. And on top of that, we still get to keep that premium the buyer paid us. So this is why it's a zero risk way to boost your income. Even in the worst case scenario, you still make a profit. So there is zero chance of losing any money. This is why the covered call strategy is one of the safest and most popular income enhancing strategies. The one downside is that during a strong bull market where the stock prices are flying high, you give up some of the stock price upside on the calls that get exercised. So how much upside do you give up? Well, it really depends how many calls the fund manager sells. BMO's covered call strategy is pretty conservative, as they only sell calls on 50% of the shares and they only sell out of the money calls, which means that the price they agree to for each contract is always a little higher than the current stock price, just like our example. So in summary, in a stable or falling stock market, all those premiums are essentially easy free money because the options will never get exercised. That's why covered call ETFs provide a small cushion during stressful times like we had back in March and April. Okay, so enough about covered calls now. Let's explore this ETF in detail. All right, so let's explore the ZWC ETF. So just like the overview, I'm in the overview tab here. If we just read what the strategy is, you could see that the ETF has been designed to provide exposure to a dividend-focused portfolio while earning call option premiums. So the underlying portfolio is yield-weighted and broadly diversified across sectors. We'll see what's in the ETF in a second. So the ETF screens for securities with dividend growth, sustainability, and option liquidity. The ETF also dynamically writes covered call options. The call options are written out of the money, like I mentioned, and selected based on analyzing the options available premium. The option premium provides limited downside protection. So that's that small cushion I was talking to you about. So you could actually see that here, the benefits. So designed for investors looking for higher income, invested in the diversified portfolio of high dividend Canadian companies. Call option writing reduces volatility. So there you have it, professionally managed by BMO. So the ETF is currently giving a really nice dividend yield of near 8%. So this is a bit outdated from November. But if we look at the current stock price, which the market just closed today on December 11th at 16.54. So the dividend yield is just under 8%. So pretty much 8%, guys. Phenomenal dividend yield. And getting back to the ETF here, you could see that the management fee is 0.65%. So you might be saying, well, it's much higher than a regular dividend ETF. Well, that's because of the call option writing. It takes more work, and in my opinion, the 0.65% management fee is well worth it. So if you actually go down, you will see here that there's a BMO covered call option strategy. If you click on that, you'll get a document which explains BMO's strategy and how they sell covered calls. And right here, you could see that out of the money or OTM call options are sold on approximately 50% of the portfolio, depending on market conditions. This gives the investor an enhanced yield and still allows for participation in rising markets. So there you go. Like I said, they write call options on 50% of the portfolio. In terms of what's in the portfolio, let's click on the holdings tab to actually see what stocks are inside the fund. So here we go. Here are the stocks inside the fund. If we just turn on the sector, so we could see what sector we're dealing with. Bank of Nova Scotia, CIBC, Manulife, Bell, Enbridge, Nutrien, which is a fertilizer company. That's why it's under materials. TD, BMO, Pembina Pipeline, CNR. So there's also some industrial. Don't forget, this is very diversified in terms of sector. TELUS, you got more banks, Shaw, TransCanada, which is basically TC Energy, Great West Life, Sun Life, and even some consumer discretionary and consumer staples like Canadian Tire. You have, of course, a lot of good utilities, the top utilities in Canada, which is Fortis, Emera. Here's another telecom, Rogers, Thomson Reuters. So Loblaw, Saputo, etc., etc. Here's some more. So basically, really the best of the best when it comes to Canadian dividend stocks. So all the stocks, not all of them, but most of the best ones are in this. You got the 6 banks, you got the 4 telecom companies, which is Bell, Telus, Rogers, and Shaw. You got the top utilities like Emera, Fortis, Hydro One, Algonquin, etc. You also have some materials like Nutrien and some industrials. So a really amazing, diverse fund here. You could actually see the breakdown all the way at the bottom. So it's a typical sector allocation in Canada, which is very heavy on the financials, the energy, and the utilities and telecom. So a really amazing way to get all the best Canadian dividend stocks all in one. It really can't get any easier than this. And if we just compare it to, let's say, a non-covered call ETF, for example, so BMO actually has a non-covered call version of this ETF. So the stock symbol is ZDV. And if we just go in overview, you could see that the dividend yield is much lower at 4.79. It might be a bit outdated, but it's about there. And the management fee for this one is less. That's because they're not writing covered calls on it. So if we look at the holdings in this one, you will see pretty much a lot of the same companies. It's pretty much identical. And the thing is, you're getting a much lower yield with this one. If we compare it to, let's say, I know everyone loves Vanguard. Let's compare it to the Vanguard High Dividend Yield Index ETF, stock symbol VDY. So if we actually go down, you could see that here it is, the distribution yield is pretty much in line like a non-covered call dividend ETF. So the 12-month average is 5.34, but the current yield, so the yield for the current distribution is only 3.58. So 3.58, 4 point whatever against 8, in my opinion, it's really a no-brainer to choose the covered call one. And if we look at what's in this one, the Vanguard, you could see the top 10 holdings here, which makes up 72% of the fund, which is the bulk. And you could see basically the same exact company. So in my opinion, ZWC, really the best way to get the biggest bang for your buck. It's simple, it's easy, it gives an 8% yield, it's monthly, it's simply phenomenal in my opinion. So if you thought it can't get any better, well then you're wrong, because there's one more advantage I want to talk to you about on ZWC, and it's the actual income that you get. It's much more tax efficient than regular ETF. So let me show you. If you click on tax and distributions, and we'll look at the 2019 one breakdown, just because 2020 the numbers are not in yet. Here's the breakdown here. So the total distribution per unit, this is for the entire year, so 12 dividends put together, you could see that here, was $1.31. So if we look at the breakdown, you could see that a little under half of the 131, so 64 cents, is considered eligible dividends, which is taxable income that you have to pay if it's in a regular cash account. Of course, if you have this in a TFSA or RRSP, this makes no difference to you. But if you have it in a cash account, you could see that half the income is taxed as eligible dividends, but the other half, or actually a little more than half, is considered return of capital income. So if you didn't know, return of capital is the only source of dividend income that is not taxed at all. So that's right, zero tax on return of capital, which simply means that if you own this ETF in a cash account, you would only have to pay taxes on the eligible dividends, but it only makes up half of your income. The other half is completely tax-free. So that's another advantage of this covered call ETF. Simply amazing. So there you have it, guys. In my opinion, ZWC is really the easiest and most efficient way to invest in the best dividend paying stocks in Canada. Number one, it's extremely easy and it's simple, since this one ETF includes already the best dividend stocks, so there's no need to pick and choose individual stocks. Number two, it provides consistent monthly income, whereas individual stocks usually provide their dividends every 3 months or quarterly. Number three, it provides a really nice high yield, higher than if you would have owned all the stocks individually. Number 4, the distributions or dividends are very tax efficient, even better than eligible dividends, which is what you'll get if you're owning the stocks individually. Of course, this only applies to a cash account. If it's an RSP or TFSA, that doesn't really matter. Number 5, it performs well during stock market volatility, providing you a nice small cushion during those stressful times thanks to those premiums. So it really can't get any easier than this, guys. Covered call ETFs are really designed for investors looking for high income now rather than later. So they're a great tool for retirees, but you really don't have to be retired to enjoy their benefits. You could enjoy the high and consistent income now. So you could pay off your phone bill, your gas, your car insurance, etc., and really take a load off your shoulders and improve your quality of life now rather than later. So even if you don't care about the income that they generate, since you have maybe a high-paying job, for example, well, just turn on the drips. I mean, those juicy dividends will keep buying you more shares every month, so the compounding effect will take place. Please hit that like button if you like this video. If you learned something, I would really appreciate it. And make sure you're subscribed, as this channel focuses on high dividend stocks and strategies for passive income investors. So my mission remains the same. It's to help everyday working Canadians invest on their own, to build their own stream of passive income so they can enhance their quality of life. So with that, thanks for watching, guys. Stay safe and see you next time.